These sessions are closely followed by investors because any comment from Powell can give hints about future monetary policy. In the worst-case scenario, oil could spike to $130 per barrel. Without a significant shift in the current geopolitical tensions, the potential of a strong dollar rebound remains limited. Welcome to this week's market analysis. I'm Isaac Martinez, trader and analyst at xChief. With tensions escalating in the Middle East and oil prices on the move, this is a critical moment for traders and investors. In this video, we'll break down the key fundamentals impacting global markets alongside technical insights on the dollar index, SP 500, Euro USD, and Bitcoin. If you want clarity in uncertain times, you are in the right place. Let's start with the economic calendar, and don't forget the hours you're going to see are based on GMT-5, which is related to the New York trading session. This week kicks off with a series of PMI releases from Europe early Monday. At 2:15 a.m., we get the French flash manufacturing and services PMIs, followed shortly after at 2:30 a.m. by Germany's data. These numbers give us a real-time look at how both the industrial and service sectors are performing in the Eurozone's two largest economies. If the figures come in strong, they can boost the euro and support risk appetite. If they are weak, it can raise concerns about the economic slowdown in the region. Later that same morning at 8:45 a.m., we get the US flash manufacturing and services PMIs. These indicators help traders understand how US businesses are doing, especially important now as markets are watching for signs for slowing activity or resilience. It can directly influence the dollar and equity indices depending on how the data compares to expectations. On Tuesday at 9 a.m., Fed Chair Jerome Powell will testify before Congress. These sessions are closely followed by investors because any comment from Powell can give hints about future monetary policy. He's also scheduled to testify again on Wednesday at the same time, so expect both sessions to potentially bring volatility to the markets. Thursday at 7:30 a.m. brings two important US data releases. First, we have the final GDP figure for the last quarter. This shows us how much the economy actually grew or contracted after all revisions. Strong growth typically support the dollar and risk assets, while a weak number can raise concerns. At the same time, we also get the weekly unemployment claims, which give us a pulse on the labor market. Finally, on Friday at 7:30 a.m., we get the core PCE price index. This is the Fed's preferred inflation gauge, and it can have a strong impact on market expectations about interest rate moves. Traders will be watching this number closely to see whether inflation is continuing to cool or showing signs of sticking. Now we will move to the most important fundamentals of the week, because investors are weighing several possible scenarios as the US considers deeper involvement in the Middle East conflict. The focus is on the exchange of missile strikes between Israel and Iran, and whether the US will officially join Israel's campaign. The biggest concern is that an escalation could severely disrupt oil supply, send energy prices soaring, push inflation higher, and reduce the chances of any rate cuts in the near term. So far, equity markets have remained relatively calm. The S&P 500 has barely moved, despite US crude oil rising nearly 10% over the week. However, analysts warn that if the conflict begins to affect Iranian oil production directly, or if the Strait of Hormuz is closed, the market reaction could be much stronger. Oxford Economics outlined three possible outcomes: from de-escalation to a full shutdown of Iranian oil supply. In the worst-case scenario, oil could spike to $130 per barrel, driving US inflation close to 6% by the end of the year, effectively ruling out any rate cuts. The most immediate impact has been in the oil market. Brent crude has jumped as much as 18% since June 10th, reaching a nearly 5-month high. Volatility expectations for oil have surpassed those of stocks and bonds, and analysts caution that further price increases could spill over into equities if supply risks intensify. Citigroup noted that while equity markets have mostly struggled off the tensions, energy prices will likely be the key driver for stocks going forward. If the US launches a military strike, an initial sell-off in equities is likely. Still, historical data suggests that such pullbacks tend to be temporary. During past conflicts such as the 2003 Iraq invasion or the 2019 attacks on Saudi oil facilities, the market initially declined but rebounded in the following months. As for the dollar, the impact could be mixed. A short-term rally is possible as traders seek safe haven assets, especially if the economic shock hits Europe, the UK or Japan more directly. But over the long term, prolonged US involvement, especially if it turns into another round of nation building, could weaken the dollar as it did following the events of 9/11 and during the wars in Iraq and Afghanistan. Let's now continue with the technical analysis, starting with the DXY, the US dollar index. The first thing to consider is that we've been seeing a recovery, and on the 4-hour chart, a structure is forming that, if confirmed, could shift into a bullish trend. Here we can see the structure that is forming right now, and only if we have the breakout of this key level, which is 99.390, we can consider more upward movements. If the DXY manages to hold above this level, we could see the price continue to recover and maintain the structure we are discussing. On the other hand, if the price fails to break above 99.390, it's unlikely we'll see a meaningful recovery in dollar strength. We also need to take into account the fundamentals we've discussed throughout this analysis. Without a significant shift in the current geopolitical tensions, the potential of a strong dollar rebound remains limited. Bullish targets for this week are set at the same price I told you, 99.390, followed by 99.668, and a final level we can consider is 100.540. Reaching levels beyond those will be difficult without a strong fundamental catalyst behind the dollar. Finally, keep in mind that the broader trend for the dollar remains bearish. You can see easily here how this current structure is, so it's likely this downtrend will continue. Bearish targets for this week are 98.483, 98.022, 97.685, and 97.602. In my view, these downside levels are much more reachable given the current setup of the dollar index. Let's move on to the SP 500. This past week has been particularly challenging for this asset as we've mostly seen noise in the price action. It's easy to understand that we were having this range this week. Because of that, we can't yet confirm any solid trend. However, the current structure is still leaning toward the upside, aiming to retest the all-time high at 6,147. That remains the main bullish target for now. Before reaching that level, we can consider an intermediate target around 6,059 USD. Based on these, new long positions could be considered, as long as we don't see any sharp declines driven by current fundamentals. On the downside, if you're positioned bearishly, key support zones to monitor are 5,921, 5,843, and 5,767. These would come into play especially if geopolitical tensions escalate. Each of these levels represent internal range liquidity zones. You can see them here. And this means that the price could react at any of them with potential rebounds, helping maintain the broader bullish structure. Personally, I'll be watching closely this week because without a clear direction, executing trades could become more complex. Now let's take a look at the Euro USD. Just as a quick reminder, we are still in a strong bullish structure, characterized by higher highs, as we can see here, and higher lows too. This suggests that the upward movement could continue. I will still keep a bullish outlook, which isn't good news for the dollar, as it means the euro continues to strengthen. Key upside targets include 1.15803, 1.16148, and 1.16317. These would be my reference levels if I were looking to trade the euro against the dollar. On the other hand, if we shift to a bearish scenario, we can identify clear liquidity zones at 1.14463, 1.14054, and 1.13730. Still, it's unlikely we'll see significant downside in the euro while the dollar continues to weaken. Lastly, let's take a look at Bitcoin. On the 4-hour chart, we can see that it has swept liquidity from several key zones, specifically from 103,363 and 102,746. From here, we should consider the possibility of a recovery toward the fair value gap area, which also aligns with the high volume zone. That price level is located around $105,000. So looking ahead into next week, we are recording this on Saturday. The first potential move could be toward that level, followed by a recovery possibly extending to 106,553 and, in the best case scenario, up to $109,000. That said, trading Bitcoin remains tricky at the moment. We don't have a clear structure or a defined direction, so a strong breakout either above resistance or below support is unlikely for now. Still, I remain bullish on Bitcoin, primarily due to the broader structure, which continues to show a clear upward trend. It's very likely that this trend will hold, allowing the price to continue moving higher. If you found this analysis helpful, make sure to like the video and subscribe to the channel for more weekly insights. And if you are ready to trade with institutional level tools and real-time data, open your account now at xChief.com. Thank you for watching, and I'll see you in the next update.